Hey guys, welcome back to the channel. I'm Luke, an ACA qualified accountant, and in today's video we're going to be introducing the concept of T accounts. We'll look at what they are, how you populate them, and how you balance them off at the end of an accounting period. T accounts are super important. They're one of the core fundamental concepts of the accounting fundamentals certificate level syllabus, so it's really important that you get a good grasp of how they work. So yeah, let's get started. Okay, so keeping the dead click rules front of mind, let's look at how T accounts behave for assets, liabilities, and capital, the key elements of the accounting equation. So starting with assets, when an asset increases, we record it on the debit side, which is the left-hand side of the T account. So for example, if a business receives cash from a customer, that's going to increase the value of assets. So we debit assets. However, if an asset decreases in value, we record that on the credit side of the T account, which is on the right-hand side of the T account. So, for example, when a business makes a cash payment, that will reduce assets. Let's look at liabilities. These work in the complete opposite way to assets. An increase in a liability, like a business taking out a loan, is recorded on the credit side, whereas a decrease in a liability, such as repaying a supplier amount owed, is recorded on the debit side. And the exact same logic that applies to liabilities also applies to capital. So if the owner introduces more funds into its business, then capital is going to increase, and that's shown on the credit side of the account. Whereas if capital is withdrawn, say through a drawing, that's going to be recorded as a debit on the left-hand side of the T account. So while assets increase on the left, liabilities and capital increase on the right. So once you start to understand this pattern, interpreting and preparing T accounts becomes much more intuitive, and recording transactions within them is going to become, over time, second nature. Okay, and then when it comes to T accounts for income and expenses, the rules again follow a similar logical pattern. So let's start with income. When a business makes sales, we record them on the credit side of the income account. That's because income increases on the right-hand side, whereas if income were to decrease, say through, a return or a refund, that would appear on the debit side. For expenses, these behave in the opposite way. When the business incurs an expense, like paying wages, a rent bill, utility bill, that's recorded on the debit side because expenses increase on the left of the account. If an expense is reduced, perhaps due to a overpayment or a refund, that's shown on the credit side. So to summarize, income increases on the credit side while expenses increase on the debit side. This all flows back to the dead click principle. So if you understand dead click, you should have a decent understanding of how this pattern is evolving. Okay, this next slide explains how cash transactions are recorded in a double entry system. So a cash transaction is any transaction that increases or decreases a business's cash bank account. In accounting, cash is an asset. That means when the business receives money, the cash balance increases, and therefore we record that as a debit. However, when the business spends money, the cash balance decreases, and that's going to be recorded as a credit because the asset value is decreasing. Every cash transaction affects two accounts. Obviously, it will affect the cash and bank account, but it also affects another account depending on what the transaction relates to. It could be income, could be an expense, could be another asset, or even a liability. So for example, if a customer pays a business cash for a sale, we debit the cash or bank account to show that the cash is coming into the business, but we also need to credit the sales account to show the income being recognised in the income statement. Whereas on the other hand, if we were to pay wages to our staff, we would credit the bank account to show the cash is going out and the assets are falling, but we also debit the wage expense account to reflect the fact that this is a cost to the business. We're paying our employees. So there's a dual effect. So Cash coming in is a debit, cash going out is credit. Okay, let's now walk through 4 common examples involving the cash at bank account to see exactly how this principle works in practice. So in this first example, we're told that a business receives £100 in cash from a customer after selling goods to them. Because the business has received money from its customer, the cash at bank account increases, and since that's an asset, we need to record a debit entry of £100 in the bank account. On the other side of the transaction, the business has earned income. They've recorded revenue from the sale, so we need to record a credit entry of £100 in the sales revenue account. This is a very common example of how a cash receipt for a sale is reflected within double entry bookkeeping. The debit records the cash coming into the company, and the credit recognises the increase in income that will flow through to the income statement. Now, instead of a cash receipt, let's look at a cash payment. So in this example, the business pays £200 in wages to its employees. So this is an expense. So we need to increase the wage expense account, which we do by recording a debit entry of £200. At the same time, cash is leaving the business because the business is paying its staff using its cash. So we credit the cash at bank account by £200 to show that the bank balance has decreased by £200. This double entry shows both the cost of paying staff and the reduction in cash used to make the payment. In this third example, we're told that a business makes a £300 cash payment to a supplier for goods. Because the business is purchasing goods or stock to resell, we record this as a debit entry of £300 in the purchaser's account. Since the payment is made immediately in cash, we credit the cash at bank account again by £300 to reflect the decrease in the business's bank balance. Again, we're applying the double entry principle, recording the value that's being received, which is in this case the goods, on the debit side, and we're also reflecting the value that's being provided, so the cash on the credit side. And finally, we're told that a business spends £400 in cash to purchase PPE. So the piece of equipment is going to be recorded as a non-current asset because this is something that the business is going to be using for a period of time which is longer than a year. So we need to record that as a debit entry in the PPE account. So we debit £400. At the same time, because cash is being used to pay for it, we need to credit the cash at bank account by £400 because again, cash is decreasing. The transaction here is basically illustrating an exchange of one asset for another. We're reducing cash because cash is leaving the business, but we're increasing the value of PPE owned by the business. So it's basically almost like an asset swap. Cash is going down, but PPE is coming in. So the double entry that we've just posted reflects both the payment by the business and the value being received, which is the piece of equipment that they're obtaining. Okay, let's finally look at how the cash at bank T account looks after all 4 transactions have taken place. So we have one debit entry of £100 for the cash sale, and we have 3 credit entries. So we have the £200 wage payment, the £300 payment which was made to the supplier, £400 payment that was made for the PPE. So that gives us a total amount on the debit side of £100 and a total on the credit side of £900. So the business in aggregate has spent £800 more than it's received. This is how the cash at bank account keeps track of all money movements in and out of the business. So to complete the account, we need to add up both sides and make them equal by inserting a balancing figure. So to do this, we follow a 4-step process. So step 1, we need to total up both sides. That's what we've done. So the debit side shows £100 from the sale, whereas the credit side shows a £900 total from the 3 payments that have been made. That's step 1 complete. Step 2, we need to make both sides equal. So we need both sides to show the same total of £900 so that the T account balances. So to do that, we need to ensure that the debit side equals £900. To do that, we insert a balancing figure called the balance carried down, and that's equal to the difference between the £900 that we need and the £100 that we have. So we insert a balancing figure of £800. Inserting that balancing figure will bring our total up from £100 to £900. And finally, step 4, in the next accounting period, this balance is brought forward as the balance brought down. You'll see it on the credit side of the T account, showing that this business starts the new period with an £800 cash overdraft. So that £800 is the balance that's carried forward to the next accounting period. So this 4-step process is known as balancing off an account. It's an essential step that accountants must follow when preparing ledger accounts for financial reporting and analysis. Okay, that's everything I wanted to discuss in this video. That's T accounts in a nutshell. If you've got any questions about how you prepare T accounts or how you balance them off, please feel free to fire them off in the comments. I'll be more than happy to answer them. If you like the video, please smash the like button and consider subscribing. I'll see you guys in the next one.